Hello everyone, Sheikh Trace here and welcome back to episode 3.1 of the long-awaited episode 3 where I finally go into my strategy, where I finally show you guys some chart execution, where I finally go over my strategy. And here we are. I've been talking about this on Discord for ages now. The preparation takes a lot of time and we've been getting insane support on the previous episodes. And I want to thank each and every one of you that liked. And before we even start, please like already. We got so many views, but the like doesn't even match it. Please like and comment. It genuinely helps a lot. And let's get into it. So Bootcamp episode 3.1. That will be a playbook explanation. I will go over my terminology. I will show you exactly everything that I use based on my terminology. So when we get into 3.2, 3.3, 3.4, when I mention certain things, you should already be familiarized with it. You should already know what I'm talking about. So in episode 3.2 and 3.3, I don't need to disrupt my flow and go back and talk about something that I already discussed in episode 3.1. So yeah, episode 3 introduces the foundation playbook strategies used by professional intraday traders, me. This model covers tactical setups, key price levels, and multi-time frame analysis techniques that form the backbone of consistent trading executions. So I'll be showing you guys everything out of context, and in the later episode we're going to go into the context of how I use everything specifically. So I pulled up a lot of charts. I have them open already on my other screen, and I'll pull them one by one as we go over through the strategy, as we'll go over through the slides, and I'll be able to show you guys exactly, let's say if I talk about a pullback, I'll be able to show you guys what I mean with my sort of pullback, my type of pullback. And in episode 3.2, 3.3, 3.4, as you guys could see in the overview, 3.1 to 3.8, I show you guys in detail how I use them. So playbook explanation, episode 3.1, will be terminology, showing you out of context what they are, and going over every setup that I have. Out of context, bear in mind, out of context, I'll just be, if I talk about a pullback, I'll just show you what I mean with a pullback, because when we go into entry and exit strategy, when we go into yesterday high and low, when we go into pre-market high and low, etc., 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 I have different scenarios when I use each of them. So yeah, episode 3.2 is going to be about entry and exit strategies. That's where I'll be going over the specific strategies that I have within context. And then episode 3.3 is going to be about yesterday high and low, how I utilize yesterday high and low. And hint for the people that were in the live stream today, we got a massive W utilizing yesterday high and low. 3.4, pre-market high and low. 3.5, gap ups and gap down, and how I trade specifically when we have a gap up and what criteria I have on when I long, when I short, which of the setups or playbooks I use that I explain in 3.1 right now. Inside days, multi-asset analysis, and 3.8 is going to be price action intraday, which is purely price action intraday, which doesn't come from a higher time frame setup. And the 3.9 is a question mark. That means that if I remember anything, I'm going to go over my notes. I'm going to go over the sticky yellow notes I have. As you can see, I have plenty of these laying around. All of these, they're just strategy things, and I have them all written down here as well, as you can see. And I'll have to go over them again. I'll have to go over through my Notion. But yeah, bar by bar break, the basis of my trading, the essentials of my trading, the foundation of my trading. I have a lot of threads about it on Twitter. I have a lot of YouTube videos about it as well. So bar by bar break, framework, entry model, no guessing on pullbacks, calculated risk. Bear that in mind. Every time frame, it's applicable on every time frame, when to use and when not to use. So the framework or entry model that I have is a bar by bar break. What is a bar by bar break? So if you look at this right here, simply every time a high or low of a candle is broken, that's a bar by bar break, as the name states. But when do I use a bar by bar break? What is it for me? It's an entry model for me. It's a trading strategy for me. It's the foundation of my trading. So we took shorts on this right here. I'm going to go over it with other examples that I have, but this break of this going below VWAP, that's a bar by bar break strategy. That's a bar by bar break entry. You don't guess on pullbacks. So when there's a pullback happening and the market goes up, 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 the market goes up, up, up. And then when you roll over and you want to short that pullback, let's say, when it keeps going up, you don't really know when you're going to take that entry. So let's say when we're going up right here, up, up, up. The only valid short that it gave was that bar break. The same with it going up. You see, we never break the lows of the candle, so we never have a valid setup to go short on. And that's just, in theory, the basis of it. Let me pull up a chart about the bar. This is the example that I have loaded up already. And what do you see here? Very simple. What do you see from my entry? You could see that I took that short as it rolled over. I'm not going to get into whatever's happening here. As I said, it's all going to be out of context. I'm going to go over it, the other models in a bit. I took this short. Well, ideally, I should have taken this short right here. But slippage and etc. It gave me a fill around these lows. I took this short right here. It pulled back. And what do you see specifically in this pullback? Even though, mind you, I didn't trade it or whatever. But what do you specifically see in this pullback? Do you see how we never break the low, never break the low, never break the low, never break the low, and then here on this candle where my mouse is going over, we're finally breaking the low. Now what does that show you? You have a calculated risk. You know where to enter. You know where your exit would be. You're entering based on this with your exit at the tops. You're risking max 20 points with a potential of making 30, 50, 60 points. And that's where my trading is based on. Fundamentally, my framework comes from bar. I take trades when it breaks a 1 minute bar or a 3 minute bar. And this gives me a nice, easy, calculated risk. It's a mechanical framework, so I only take a trade if that happens. Sometimes it could be due to slippage, or sometimes within the series you'll see that I also have some trades that aren't specifically based on the bar, but that could be because I'm entering half size and I never got the chance to add my full size as it does the 1 minute bar, because I don't want to ruin my average. But you'll see that my trading is fundamentally based on those 1 minute bar, and that happens here because I do want a short, and then you could see we fill those levels, we go down, and this is my entry trigger, and then we pull back. And let's say if I wasn't in with full size, I would take my remaining size here, and then we get a nice rollover, and then we get the remaining rollover. And that specifically builds the foundation of my trading, bar by bars. I'll even pull up a nice thread that I wrote, and I still believe it's very applicable, that I wrote in September, 1st of September, which is a couple of months ago. But you can see we're going to go over it very quickly. 1 minute bar entry, that's the entry model that I use, that I'll go over in episode 3.2, but I'll just explain it here out of context so it's a bit easier for you to understand when we go over the coming episodes. You'll see that it's a entry model that gives me better entries, tighter risk, no matter which model or strategy you use. So this is also applicable for people that are already successful traders, that already have a model that works for them. I'll show you examples, live execution of my own trading entries from August. And we're just going to get straight into it. For longs, I wait for the current candle to break the previous candle's high, whether it's in a pullback or a trade I take based on a key level. So it comes from a key level. It comes from a strategy that I have already, and I take it based on that. So the example, the 12th of August, notice how many entries are so accurate that if and when I'm right, I experience minimal drawdown, hence have higher risk, giving me more EV. EV will be explained as well in the longer run, resulting in a positive equity curve. So you could see when I took this trade, I took it when it exactly, let's see if I can zoom in. Yeah, when it exactly broke this 1 minute bar. So we go down, we break the 1 minute bar. I'm risking the loss for $475 and I'm making $1,200, which is a 3R trade. Same for this, which is a pullback continuation, which I'll go over literally in a couple of minutes. I take it at a 1 minute bar. So the setups that I'm seeing right here, they come from different playbooks, and I'll go over the playbooks in a couple of minutes. But the bar by bar break, you will notice also when I'm going over my playbooks that all my entries, 90% of my entries come from this bar by bar. So whenever I say bar by bar, this is what I mean with a bar by bar. So for shorts, I wait for the current candle to break the previous candle's lows, whether it's in a pullback or a trade I take based off a key level. So whether it's in a pullback, when I'm trying to go short, or it's based on a key level, I'll wait for the 1 minute bar by bar break to happen. And then what do you see? Once again, we're going down, chop, going down, and I take my trade right around here. Mind you, all those trades are on Discord. They're also on my live stream. and I take this trade right around here. What happens here? I'm trying to join the pullback. I'm trying to join the momentum of it going down. And where do I do it? I do that when I feel like the 1 minute bar has happened. So this setup in general is coming from a different playbook that I have. I went short not only because it's doing a 1 minute bar, it also does it here, it also does it here, it also does it here. But once I realize, okay, my playbook is there, now is the time that I want to go short, then I take my short. And I just don't take shorts randomly. I take it with a mechanical framework. I go short because the 1 minute bar has happened. And then I've got some more examples. Notice my entries. So you could just watch my entries, and I think it's a bit self-explanatory that every time, you know, I'm trying to join this pullback, and the most logical time for me to enter this trade, it wasn't here, it wasn't here, that's way too wide, it isn't here, it isn't here, it isn't here, it isn't here, it's finally here, and I take my trade. Same with this, you could see that it ran all the way. Same with this, you know, same with this. You could see that they're running, and then some examples for shorts. You could see I'm taking this here. I didn't take it on these candles, I'm taking it here. I'm risking the highs for 212, and I'm already up 1 hour, and I think this trade worked out perfectly, as you guys could see, yeah. And I'm making 635, and has a 3-hour trade. So that framework that I'm using, this is another setup that I'll go explain as well, but those are my executions for people that are doubting. But yeah, so you could see that this is technically a entry model slash setup model slash framework. So everything I do, even if you've been watching the streams, comes from the bar by bar. It's applicable for every time frame. It's applicable for every trading strategy. It's just a basic framework that gives you a good place to enter and have a specified risk, and when not to use, and when to use. So when not to is when you're taking a bar by bar break, it's coming from a specific strategy, it's coming from a specific setup. I don't randomly just take every bar by bar break. I don't randomly just trade every time a candle's high or candle's low is broken. You have to have a strategy. You have to have a playbook. You have to have something where you're like, okay, I want to go short. You've made up your mind. You're like, okay, I want to go short. Where do I want to go short? So I know that, okay, on this key level, whatever, you know, at $100 when the NQ reaches 26,000, 25,500, whatever, I want to go short. Now that I've decided and I've made up my mind that I want to go short or long, that's where the 1 minute bar by bar comes in handy. Then you've got backside rollovers. You'll see me talk about backside rollovers a lot as well. What are backside rollovers? Backside rollovers is the backside of the move. You've got the front side and the backside. The backside is when a price is moving up. So this first leg that we have here, this is the front side. This is still the first pullback, still the front side. This, whatever is happening here, is the backside of the moves. That's the back end of the move. That's what I call the rollover. So, and then you've got the backside, which is here. And then once it's roll over, so in short scenarios, when it rolls over like these, that's what I call a rollover. So bear in mind, I use this terminology a lot. And what is the relevancy to EV versus front side? So a lot of people say, okay, if I take an entry here, I short here, right at 25,190, so this level here, and I short 25,190 here as well, I'm technically entering at the same price level. And if I make 50 points on them, whether I make it from here all the way to here, or from here all the way to here, I'm making my 50 points. And monetarily, value-wise, it's the same thing. EV-wise, it's not the same thing. The amount of drawdown you're taking, the amount of MAE, the max equity loss that it goes against you, that all decides EV. And I'll not get too deep into EV because it has a whole separate episode for it, but it's not the same when you're shorting the front side versus the back side. I always, which you will see also in my trades, aim or hope to only trade the back side, whether it be long for short. So this is a short example, but a back side for a long example is, for example, instead of longing this at 25,140 right here, versus longing it here on this candle at 25,140, this is a front side long and this is a back side long. And I always try and aim to only trade the 25,140 on the right side, on the back side of the move. And this usually gives me a nice indication that I have a predefined risk. So I know that I'm not catching a falling knife. The same with the front side movement, shorting, catching a massive pump. I know that if I'm right, that I should experience minimal drawdown, which in the long run increases your risk to reward, which in the long run increases your expected value, which in the long run increases your equity curve, so you're making more over time. And in general, yeah, you'll see me talk about backside or rollover a lot. And I have a couple of examples, which I don't mind sharing with you. So let's go over the first trade. This is the first example. And as I said, I'm not going to explain why I went short. I'm not going to explain the reason why I went short on this. I'm not going to go into the strategy because today is just going to be showing you my execution, showing you my strategy, showing you my terminology, the terms I use, the playbooks that I have. And then we're going to go over the strategies on why I use this. Why did I go short? So I'm not going to explain why I went short. I'm going to explain the reason, the playbook that I have. But, you know, this could come from a gap up day. This could come from a gap down day. But we'll get into that like in the coming episode. So I went short here. And you could see that my short is based on this. This is where I went short. Ideally, I should have been short on this. But I was already short as it went and I saw already equities going down. That is multi-asset analysis, but I'll get that into that also in the later episodes. Or it's even today multi-asset analysis. I think it's at the end of the slide. But yeah, in general, I went short right here. And what is this? That's a backside rollover. I'm trading the backside, so I'm not shorting this here. I'm not shorting this here. I'm not shorting this here. I'm trading this as we get the backside. You know, as we get that massive backside move, we pull back and then we get the rollover. And that's what I call a rollover. So for a lot of you in the coming episodes or in the coming recording of this, if you hear me rollover, that's what I mean with a rollover. Like in the other example, rollover 2. What do we have? We have this and we have this. Let's have them both side by side. Yes. So you could see that I'll always try to show you my exact, because if I only show you this is not going to give you a good indication where I exactly entered and where I exactly exited. The only reason I'm attaching this is so you guys watching at home don't call me a hindsight trader, because I could have just as well placed this here, you know. There's no way for you to verify that I exactly had those entries. But this gives you the confirmation, and this is sort of my proof or evidence that I did take this trade. So I'll always have them up, just so it could be that sometimes I don't have them because I haven't taken a screenshot of it, but I'll have them 95% of the time, and that's just how I roll. I also like to sort of prove to you guys, since I'm fairly new, prove to you guys that whatever I'm talking, like my money is where my mouth is. So you can see I traded this. Why did I trade this? Roll over. Very simple. And you could see, once again, 1 minute bar break. I'm not going to go too in detail about it, but once again, 1 minute bar break. I took this trade, it's a rollover. So whenever a rollover happens, this is what I mean with a rollover. We're coming down, we're rolling over to continue down. Easy as that. And why did I exit? Episode 3.2, gonna explain entry exit strategy. Literally gonna explain why I exited this. I could give you a teaser, filled FBD thread. So if I'm in a short and this reclaimed, that's what I call an FBD thread. But as I said, 3.2, that's where I go over the entry and exit strategies. So yeah, that's a second example for the rollover. And then you've got the third example. I don't know why it keeps opening the other page. And as I said, I'm trying to do this as raw as possible, unedited. You could see I'm pulling up my folders as we go along. You know, I could also edit this out, but I'm just trying to keep it as raw as possible. Let my thoughts speak to you, and just keep it as natural as possible. What do you see here again? Completely different examples. We go up, chop, chop, chop. I don't short here, which is valid. I wish I was able to short that. I don't short this. I don't short this. I don't short this. I short the backside. We're in the backside of the move. We're finally rolling over. We're rolling over. We're breaking higher lows. We're making new lows. We are in the backside of that move. And that's where I take my trade. And once again, what do you notice? The bar by bar break. I entered only when it did the 1 minute bar by bar break. You know, yeah, I wish I exactly going to fill at 520s, but I didn't. But I entered when it did the bar by bar break. And you could see I'm up $565. You know, I was risking these highs. 210, 220s. So once again, whenever I talk about rollovers, those are rollovers. Then we got filled breakouts and filled breakdowns. Please, every slide, you could even pause them, read them, because I'll be using them a lot. They're the fundamentals of my playbooks. All my trades come from everything that I mentioned here. Filled breakouts and filled breakdowns. filled breakouts, which I call FBO'S, and filled breakdowns, which I call FBDs, occur when price attempts to move above or below, above 4 FBO'S, below 4 FBDs, important levels, but cannot sustain the move. These are among the strongest reversal signals available to traders. A lot of people call them liquidity traps. You've got plenty of other names for them. I call them FBDs and FBO'S. I have studied it like that for the past 7 years. My mentors told me like that. Filled breakouts. Price breaks above resistance but quickly reverses back below it. Filled breakdowns. Price breaks below support but immediately recovers above it. Key point. FBDs and FBO'S are setups or playbooks that could occur on a higher time frame as well as intraday, which we call a mini FBD. And I'll show you what I mean with that. What I mean with an FBD and FBO, a setup or playbooks, they're models which, if they happen and I want to go long, give me the courage to go long, but they're also strategies on themselves. So when it fills a pre-market high or it fills a certain key level, goes up, fills that level, comes back down, that's also an FBO. I don't necessarily need to have a whole nother thing to see it play out. So you've got two cases, on a higher time frame basis and a lower time frame basis. And I'll show you exactly. Got charts for this already as well. FBD. If you look at this, you're like, yeah, what happened here? We go down at open, pull back, 1 minute bar, once again. Nice short, but we didn't take it. Goes down, comes back up. I'm not trading this. This is the front side. I'm not just longing randomly into weakness. Pulls back. What is this? That's the low of day. What do we do on the low of day? We fill the low of day. You see buyers stepping up. You see it holding highs. And then what do we do? At 260s. I'm like, okay, I see buyers stepping up. We failed to break down out of low of day. I go long, take some partials, and unfortunately, I wanted the higher move up, didn't get it. So be it, can't do much about it. But this is then a FBD, and that's a mini FBD, what I sometimes call. Second example, I'm gonna have them all laid up next to each other. I think that would be a bit better. Executions and the visuals. Yeah, this is also nice. Let's arrange them. Yes. Another example. We go down, and this is somewhere around midday. We go up, down, fill these levels, go down. Sharp knife, reclaim. This is what I call a mini FBD. We go down, we fill these levels, so it doesn't only need to fill a key level like this. So this is a key level, and then you could see I don't take this. It comes back down, fills this mini FBD, does a higher time frame FBD. So this is the 1 minute chart, and on the 5 minute, it does a higher time frame FBD. I go long, take some out, take some out, take some out. Gorgeous trade. And you could see this is my executions. Take a trade here, and you could see it necessarily didn't do a 1 minute bar by bar, which if it did, I'm okay with taking it. Like even if I didn't take it, I would 100% taken it if it did a 1 minute bar by bar. But it did a mini FBD, and that's already enough for me. I already know, okay, we failed to go lower. We broke down of these intraday key levels. And once again, I'm talking to you out of context. So I'm not going to go into why I went long, what my reason was on going long. I'm just going to show you that I went long with the FBD model, and you could see that it worked. And then later we're going to go into the context of everything. I went long, and that's what I call an FBD. Please study those terminology. If you're watching my stream, if you're trying to learn how I trade or the way I trade, you need to know those terminologies. This is what I call an FBD, mini FBD. And then as you can see, gorgeous, gorgeous trade. Ignore these. These are other examples that I took. You could see this was a L, and this was a break-even trade. But you could see that once I was initially short, but why did I go short? Filled FBD, which I'm going to go in the next slide over. We break these levels, come back down, reclaim these levels, and I catch a massive long. So now you guys are also familiarized with what I mean with FBDs. Then we're going to go over FBO'S. You could already guess, exact same thing what I mean. And I have a lot of examples for FBO'S, just easier to find for me. I like shorting a bit more. Very recent example. What do you see? I'm not going to explain why I went short. But one thing you notice here, what is this? That's what I mean with a higher time frame FBO. On the higher time frame, the 3-minute, the 5-minute, the 15-minute, we trapped buyers in this zone. We filled breakout of this zone. We filled those levels at 25 to 60s to 25 to 70s. We went up, came back down, and I'm slamming shorts. We have an FBO. The other example that I showed you with the FBO was a mini FBD. You know, we fill those levels and I catch a gorgeous short. And as you can see, here I have my exit, 3 contracts short. And I was able to take some out here and the rest out here. That's one of them. The second one, you could see. I'll leave the visuals for now, show that in a bit. You could see, what do? We fill these levels. We come down, 1 minute bar by bar. I enter, out, out. Gorgeous trade. And as you can see here, my proof that I took it. Visuals. Those are all the trades that I took. All the trades that I took. And then what do you see? This is the exact example. And as I said, I'm not going to explain why I had a bearish bias that I wanted short, because you could see that there's a reason that I went short, but I'm just going to show you what I mean with an FBO. And this is an FBO. We fill these levels. We get slammed back down, 1 minute bar by bar. I take my trade. I get my trade. That's it. It kind of shows that, I don't know, I'll be very happy if I was learning and someone was showing me like that. But yeah, we're going to go into FBO 3. The third example, along with my executions. What do you have here? We fill these levels. I'm not shorting this. 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 Where did I go short? I literally go short as we fill this. And once again, there must be a reason I was short that day. There was a reason I had a bearish bias. Because trust me, if I had a bullish bias on a day like that, no matter, even if it does a perfect setup like this, I'm still not taking it because my higher time frame bias is not aligning with it. But just so you guys understand what an FBO is, and so later when I get into all of that and I say FBO, FBD, you guys know what I mean with it. And you could see, we fill these levels. I take a short, cover, cover. This is the trade, $424 on that trade. Even probably more with the parts that I was taking down later. Fourth example, there you go. What do you see here? Once again, we fill these major key levels. We fill these major key levels. We fill this mini FBO. So we have a major FBO, mini FBO. We roll over. Once again, see, I'm naturally saying roll over and backside a lot, so know them. We roll over. We're rolling over into it. I take my short. I'm risking these highs. I'm risking 10 points. How much did I make? 50, 60 points. 6-hour trade, 5-hour trade. And I could go on and on about it. And as you guys could see, major FBO, mini FBO, taking my short, major trade. But familiarize yourself with those terms. Filled FBDs and FBOs. What is a filled FBD and FBO? So we have FBD, FBOs, and we have when it fills them. And remember, I sometimes also call them distribution patterns. When the failure fills, so you got filled FBD, filled FBOs, and what does it actually mean? That means that initially we fill it, and then we go back up. So if I pull up, I think it's good if I pull up another example. So for instance, the example that we just went over for the FBO, it does an FBO here, rolls over, we take the short. But what if it went back up? That's also something I trade. That's what I called a filled FBO. And that's what I will go over in this example here. A filled FBO or FBD represents a secondary layer of market indecision. After an initial filled move, price attempts to reverse again, but cannot commit to the new direction either. This double failure pattern often indicates choppy range-bound condition where neither bulls nor bears have control. Momentum is shifting, but hasn't found a clear direction yet. Trading implication. Avoid forcing directional bias during these conditions. Wait for a decisive break and hold. So it does an FBO. And then you're like, okay, what do we do now? If I see it, I think a very good example could be the ones that I have already loaded up. I'm going to show you the examples in a bit, but a very good example could be that when we're failing those levels, so let's say the short that we took or the long that we took, and we're doing filled breakdown in FBD, and then we're rolling over again. And I remember that, let's go back to the visuals. I think this would be very good to show. Yeah. So you could see that I took this short. Why did I take this short? Distribution pattern, filled FBD. We go up, down, we go back up, and then we're rolling over. Once again, remember, roll over. This is the backside. 1 minute, bar by bar, I take my trade. This is a filled FBD. I took this trade because we hadn't filled FBD. We filled the filled breakdown. So I was like, okay, we're going to roll over. And what do you see? We go back down. I'm up. I put stop loss break even because we already made new lows. And unfortunately, I get taken out. And then it does a leg lower. And I don't chase it. You know, I don't get mad. I'm like, okay, so be it. This trade just isn't meant for me. Then we do a mini FBD. And then I go long. So very beautiful how this played out. But this is what I mean with a failed FBD. And then we've got the... I'm going to go over to the real examples of the failed FBD and FBOs. But in general, to keep it simple, it's when an FBD or FBO happens, and then it fills that level again. So we're going to fill a level, we're going to break out, fill that level, and then we're going to re-break it. And sometimes I also call it holding. And that happens a lot with pre-market highs and pre-market lows. And then we're going to go over the filled FBDs. So that's the first example. Filled FBTL. And then the executions. Let's close this. Let's see what they are. You could see, matter of fact, that's the other example that I showed you. You could see that I went short here. Why did I go short there? Ignore this chart for now. We're going to go over this in a bit. Why did I go short there? I went short because it did a failed FBD. We held this level, massive volume, and I thought, okay, we're going to pull back and continue. We roll over, 1 minute bar by bar. We fill these levels again, confirming that we're failing the breakdown, confirming that we're going to distribute, and I take my short. Rolls over, get our break even, sucks. Would have been a nice 50-ish point trade. Yeah, would have been, 40, 30 point trade. Risking these highs, 30 point trade, nice 1-to-1 R. And I wanted more, didn't get it, but you could see, failed FBD. Another example, this is it. Once again, to prove that I do good. But then another example that did work out. See that those two examples that I had opened up, let me show it. Those two are literally, why does it do that to me? There you go. What do you see? Same exact pattern. Different day, different patterns. Different day, same pattern. Go up, down, fill these levels. I'm like, okay, if I don't want to long because I came into the day with a bearish mindset. So yes, this is an FBD. You could tell me, but you know, share, this is an FBD. Yes, it's an FBD. But I told you, there must be a reason that I'm using them. There must be something supporting my claim, a bias, a strategy, something where I'm like, okay, I want to go long. And if I had a bullish bias, I bet you I would have taken this long and I would have lost money. It is what it is. But on that day, I had a very bearish bias. I remember that. I think we were breaking lows or something. But yeah, we had a buy. And as I said, I'm not going to go into context why I was bearish. That's going to come. But I was very short on that day. I was bearish and I wanted short. And why did I go short? We have a FBD. We don't hold it. We come back down. Chop, 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 chop. Ideally, should have had an entry right around these levels. Didn't. Rolls over, and I take my entry right around here. I'm like, okay, we're breaking that level. So this is the FBD level that we had, and we're failing that level. So it makes a failed FBD distribution pattern. So I take a short. Heavy conviction. I take it with 10 contracts. Go to trade. And you could see 6 contracts on this trade. Unfortunately, I went out break even. Remember, this is the setup. This is how it played out for me on this day. I got out break even, and you could see it never worked. It reversed on me. I was able to take the longs here, but it's very normal that something doesn't work. Nothing in trading is guaranteed. The only thing I could do in that scenario, in that case, was manage my risk, and I did. And if it doesn't work, I don't go and stamp the table and be mad. So be it, because I know out of the 10 times that I trade this, 7 times it's gonna work, and I make sure I make money all the 7 times that it works, and I make sure that on those 3 times or 4 times that it doesn't work, I just manage my risk. I lose small. That's how trading in general is. And now what do we have? Failed FBOs. I have a little cute example. What do you see? Same vibe. It's literally the opposite of the failed FBD. What do you see? This is the FBO level that we have. We go up, we fail it, and you know, small grandy day for the ones in stream every day know what I mean with a small grandy day. This is a small granding day. I never short into that, or I try to never short into that. Sometimes I still do, but we fill these levels, we come down, and what do? We have a filled FBO. We fill that filled breakout. So what does it mean? We reclaim that FBO level. This is an FBO level. You reclaim that level. Now what do? I see the bid stepping up, I go long. So that's a filled FBO. So whenever I say filled FBO, this is what I mean with a filled FBO. We go, roll over, and gorgeous trade. And you could see I'm risking $135. I'm already up 415, and I even made more that day. So that was it about failed FBDs and FBOs. Oop. Expected value. What is expected value, you might ask? Profit potential, risk assessment, risk to reward ratio. Expected value, there's a mathematical formula for it, but I'm not going to go too in detail about it for another episode. We'll leave that for there. Expected value is whenever I say, once again, remember the terminology. Remember that when I say EV, I'm just saying this so you know when I talk about EV, you know what I mean. But expected value, whenever I say a trade has lots of expected value or low expected value, that means a trade has the potential to run a lot. High EV trades, high expected value trades have the potential to run multiple legs. Low EV trades have the potential to not run a lot. They're base hits usually. So that's how I see them. Low EV trades, they're base hits. Low EV trades should be considered base hits. High EV trades allow me for larger positioning, allow me to hold through pullback because they're in high EV trade. The profit potential, risk estimate, risk to reward ratio. Trades coming from higher time frame analysis usually have this higher EV. When I take a trade from a higher time frame analysis, I know that I can expect multiple legs and I can make a lot of money, and that's a higher EV trade. And lower time frame analysis trades, where it's just a quick mini FBD or just a quick pullback trade, they're lower EVs, and those are just base hits. And as I said in episode 2, we went over holding through pullbacks and high time frame, low time frame setup. So watch that if you haven't already. Whenever a trade has a lot of EV, so let's show you this EV, which also comes with risk management. That's what I mean with an EV. So I'm taking a trade, I'm longing a trade. I have a wider stop loss on it. You could see already, I'm not risking these lows. I have a wider stop loss on it. It's a higher EV trade for me. I remember on IWM, the daily was setting up so nicely that I wanted to trade that massive breakout that has been forming the past 7 months, 6 months, something like that. It was a multi-base breakout. And you could see I have a wider stop loss because I remember even adding more size to this as it was going up. That's a higher EV trade. Second example, that gold short that went viral on Twitter where I made like 10R on it. Short more, cover. I'm not getting worried about getting out on these levels. It's a higher EV trade. It's a higher time frame setup trade. This is the executions once again, you could see. And yeah, those are all the other trades that I took. And you can see this is the example of the mini FBD. So a trade like this, it's not a high EV trade. This is just a small intraday setup trade that I took. So I don't expect this to go all the way back to high of day and ran 200, 300 points. I just take whatever it gives me. Whereas with higher time frame setup, with high EV trades, I do expect it to do that. And that's why I call them high EV trades. And that's why I make a lot of money with them when they work. And then you've got my 2 risk management examples that also cover high EV. So you could see that my risk is very small every time. Like even though, yes, this rolled over all the way, sucks to be me. I'm shorting here, 1 minute bar, roll over backside. And unfortunately it pulls back and I thought, okay, it's going to work. I take my L as it broke these highs. And this tight risk is allowing me to have a higher EV because every time I lose this amount, which is 20 points, 15 points, whatever, and I win more than I lose, and every time I'm only losing this small, 20 points, compared to the massive trades that I take, those high EV trades where I make 60, 80, 100, 150 points, allows me to have a higher EV value of my equity curve. So whenever people ask, yeah, but why are you trading so tight? This would have worked. It's because I'm not trying to ruin my EV. I'm not trying to ruin my equity curve. I'm okay with taking tight risk stop loss like that. It's part of the game. That's who I am. I'm okay with that because in the long run, it grows my account more than if I were to have a wider stop loss. This is the reason my equity curve is only going up. Kind of good example to show. And once again, see, I'm short on a day like this. It saved me. It saved me from losing a lot of money because I'm okay. But a lot of people were like, yeah, you should have a wider stop loss. But what about this? If I had a wider stop loss, I would have had a massive L. That's not me. I'd rather take smaller L's. Break evens. And you see, I take a lot of break evens. I take a lot of smaller L's. And my W's, they're massive. Huge risk to rewards. Huge EV. And that's the reason why my equity curve is slowly only going up. I also have in my equity curve major corrections or whatever. But in general, in the long run, I know that I'm making money, and I know that my equity curve is gonna grow. And then we're gonna go into pullback, refresh, and momentum continuation. One of my favorites, and something you should, once again, study very well. Even maybe rewatch this or whatever, but know this very well because I use this a lot. You've got a basic pullback. Those pullbacks fall into two categories for me. They fall into the refresh and they fall into momentum continuation. A lot of people would say, yeah, a pullback is a pullback. No, it isn't. For me, it isn't. I think a very basic example that I just put here for the aesthetics. If I want to long this is very strong, and I want to long this pullback. We have a pullback. We break. We come back down. Refresh. 1 minute bar around there. Long. For a lot of people, they would be, okay, I'm going to trade a pullback. Yeah, I'm just going to buy here, buy here, buy here, buy here. Eventually, it's going to work. They're just randomly buying. Once again, why the 1 minute bar comes in very handy with a calculated risk. But I take this trade only if it gives me a refresh. So I'm not randomly buying these dips. I'm not randomly longing this. I'm not randomly buying this. I need to see something. So it's either going to be a momentum continuation or it's going to be a refresh. And I'm going to show examples for that. Keep in mind, first leg, second leg, third leg. What does it do with EV? Whenever we have a trade, and sometimes when we have massive rallies, I'm only able to take a trade for the initial move, the first pullback, and that's it. So if I miss the initial move, I'm okay with entering the first pullback, but I don't trade the second, the third, the fourth. The more legs we make, the lower the EV. Once the trade goes up, and we're already up 150 points, pulls back down, I trade the first pullback, goes up another 50, goes up another 100. I don't trade that anymore. I don't like trading setups that already did 3, 4, 5, 6 pullbacks. I never do that, and I'll never will. EV gets diminished because the chances of it reversing anytime, which is very normal, the chance of it reversing anytime is higher than the amount of money I could make. So I'm now chasing a move, and what do I always say with chase? It's either you're going to win small or you're going to lose a lot of money. And that's why they're low EV trades. The expected value of that trade, of that long working out at the fourth pullback is very low. Whereas the expected value of the first leg, the first pullback, going for a continuation is very high. We have a massive move. It's very normal to expect the pullback to go back up again. But it's not very normal to expect a pullback, to accept a massive move, pullback, move, pullback, move, pullback. It's not going to be endless. You know, the market will rotate back down. It will roll over. It will have a backside. So third legs, fourth legs, second legs, they're low EV trades for me. The expected value, the probability of it going down is higher for me than it going up. So I don't long those anymore. That's why I look to trade the reversal, the trade the backside, the rollovers. Let me show you an example with what I mean with pullbacks momentum and pullbacks refreshers. Pullback Momo, which I also sometimes call it. So if you hear me say pullback Momo, that means pullback momentum or momentum continuation, whatever I call them. But this is one example. You could see massive move down. I don't short this. I don't short this. I don't short this. What do I short? I short the 1 minute bar by bar. I hope so, but this is where it only gives me a later fill. But it pulls back 1 minute bar by bar. And what do we see? This is a pullback momentum continuation. There's a lot of momentum to the downside. And I'm not just randomly shorting. No, I need to see a quick pullback and I'm trading it. And what is this? This is the first pullback. And I'm okay with trading the first pullback. If it went and rolled over, I don't trade that anymore. The first pullback is already gone. The expected value, the probability of this trade working out is way higher than the probability of the second leg working out, the third leg working out. Because at some point, if it keep on going down like that, we are going to have a point where buyers are going to step up and have a filled breakdown and go back up. There you go. Well, yeah, this is the other trade that worked out perfectly. This is the continuation of that. So you could see, took the short, and you could see, I think very, very good. Good that I opened it. We take the short. What do we have here? The second pullback of the move. Have you seen me taking more trades here? No, I don't. I already have a good entry. First pullback. I don't trade the second pullback because me being in already at the top gives me chance to see and react to this. So let's say this pullback, and if I saw it chopping up, holding back up, and I see buyers stepping up, I'm out. I make my 30 points, 40 points, whatever it is. I make that and I'm happy with it. But imagine you're entering at the second pullback where the probability of it going, each new leg it makes it diminishes the probability, it increases the probability by a factor of 2 of it reversing. So if it's going up, every extra pullback it does increases the probability twice as much of it rolling over. And if you're short and it goes down, first pullback, the probability of it continuing, let's say, is 50% or 80%, and then it goes down, and the probability of the second pullback continuing down is only going to be 30%, and then the third pullback is only going to be 15%. So it's always halving the probability of it working in your favor. So I stay away from them, because in the trading is a long run game. I'm trying to only take A+ setup trades, high EV trades. So you can see I'm not taking this trade, but I'm okay with holding because I'm on top of the hill. Like, genuinely, I'm on top of the hill. I have full control of what's happening. What is the worst case that could happen? It takes me out break even. I don't care. I didn't lose money. Protecting capital is the most important thing. And you could see pullback momentum continuation. I take this trade. It works out perfectly. I make $980 on this. Second example, Momo continuation 2. There you go. What is this? There's the first pullback. I missed it. And you could see I'm not chasing it here. I'm not chasing it here. I chase it right here. And one thing which is unfortunate, I remember that day I was only in with half size because I was hoping for a rollover so I can add more. But you can see this is a pullback momentum continuation. I'm joining the momentum. I'm joining the trade as it's going down. I'm trying to get a piece of it. And you could see if I was already out earlier, but if I wasn't out, this is where I would have 100% be out. I wouldn't be I wouldn't be holding through this pullback. And that's just how I trade. And then let me show you an example of what I mean with the refreshers. So that was momentum continuation. And then we have refreshers. Please remember them because I use them a lot. Pullback refresh 1. What is a refresh? It's a set of patterns. So I'll explain it here. So we have the first move up. This is the first pullback, these two candles. A lot of people are already longing this, which is okay. You know, it works. It will eventually work, but I don't do that. We never get a 1 minute bar break. We go back down. Never get a 1 minute bar break. This is not a 1 minute bar break for me, guys. The only reason I took this trade as that candle opened, because we did the refresh. And I'll show you even more examples on this. I already see a couple. A refresh is when there is a leg up, a normal pullback, and then it sort of does a pullback within a pullback. That's what I call the refresh. It refreshes that move. So we're going to go up, down, up, and then for me, a normal pullback, a momentum continuation would just straight go up. That's a momentum continuation. But then it goes back down again, and what does it do? It refreshes that move. It refreshes that pullback. It gets new buyers in, and then I'll go long. And then you could see, works out perfectly. And that's the same with this. We go down. If I didn't trade this, but I already see that example. We go down, we go up, and I'm not just randomly shorting this. No, we pump back up, come back down, and we do a refresh. And you have the same. Let's see if I can find another example. No, unfortunately I cannot. But those are the examples that what I mean with a refresh. Now I have a couple more showing. So if you don't understand yet, that's okay. Second example. Very good example. Yes. First leg up. So kind of crazy that you could see that if I don't long this, it never did a refresh. You could see it goes up, goes down, goes up, never makes the 1 minute bar for me to go up, and then we fail it. And then what happens? We see, I remember that day, that was a VWAP bounce. We go up, down, mini up. This is also a valid long. I didn't take it, but it's a valid long. So yes, this is a refresh. Red again, 1 minute bar, and I get filled here. And this is a refresh. It went up, down. So it's usually up, down, and then that's called a refresh. And then that backside is where I long. So whenever I say pullback refresh, that's a refresh. Very easy trade. And you could see I longed out, and the rest break even because I was hoping for a bigger move, but it never gave it to me. So that's a pullback refresh. And you could see this is my entry. Goes up, down, and then it refreshes this move. So as I said, this is already valid for a long, but I didn't take it, which is okay. Comes back down, goes back up, and I already know that the refresh is complete, so I'll be looking for longs. And so yeah, whenever I say pullback refresh, that's what I mean with a pullback refresh. Sort of an extra confirmation for the pullback. Another example. It's, yeah, Literally, it's just same patterns repeating over and over again. Different days, same exact pattern. Matter of fact, for a second, I thought it was the same chart that I had opened. So you could see, very massive move up. And we're in a very bullish day. And what do you see here? Up, pullback, up. Momentum continuation. Exactly a momentum continuation. I didn't trade it, unfortunately, but a momentum continuation. We go up, down, up, massive move up. So now I'm interested. I'm trying to join the longs. Pullback. I'm not randomly buying this. I'm not randomly buying this. I'm not randomly buying this candle, you know. What happens? What did I say? Down candle, reclaim candle, refresh. So what happens? It goes down, reclaims, refresh, I go long. Unfortunately, it was a break-even trade. You know, I'm being honest. I'm showing you that it's a break-even trade. But this would have worked for a nice trade. I went out break-even, would have worked for a nice trade. It's just about the setup. And as I said, contextually, ignore it. Look at the setup. Up, down, up. And now, if this continues up, that's a momentum continuation. Very normal pullback that we all know, that you guys already know. But it fills it. But just because it does this red candle doesn't mean I go short. I like that. Holds it, refreshes, and then we go long. Very easy. So that's a pullback refresh. Study them. Core indicators. So you'll see on my charts, I have certain indicators that I use. The VWAP, the EMA 13, the EMA 9. The EMA 9, you could sort of ignore that. I don't really worry about the EMA 9. The EMA 13 and the VWAP, the two most used indicators in the past 6 years. I've never used anything more than that. An EMA is called an exponential moving average. The EMA provides a smooth trend line that reacts faster to recent price changes than simple moving average. Volume weighted average price. That's the average volume, and it's only intraday. So volume weighted EMA comes also from other sessions, but the volume weighted average price, the VWAP, is only for that specific session. What is the volume weighted average price? The VWAP represents the average price weighted by volume. It resets daily at market open. Institutional traders use it as a benchmark. So that's not only that's the only thing that we as retail traders have in common with institutional traders. That single VWAP. Whether price is trading above or below VWAP indicates who is in control. Above VWAP is technically meaning that the buyer is in control. Below VWAP, sellers in control. And I do have some trades that I took on the VWAP. You could see indicates VWAP. So there are two cases that I use VWAP. A break and retest, just like a normal support and resistance level, just like a normal key level. For me, a VWAP is more of a key level. It's a dynamic key level, just same as the EMA. But the EMA has more use to it, which I'll explain in a couple of minutes. The VWAP has a break that I trade, if it breaks it, which I call the reclaim for a reversal, or it has a retest. So it either breaks or it retests it. Break and reclaim or retest. The first example is a VWAP break. Ignore all these trades. Nice day. I remember I was massively green on that day because of this trade, but I'll get into it in a second. This massive thick blue line, that's what I call my VWAP. That's my VWAP, and it's always a thick blue line for me. So every time you see that on my chart, you know that's VWAP. You could see we fill VWAP. So what do? We initially hold VWAP, and you could take longs on it. I'm pretty sure some scalpers got nice longs of it. We then break VWAP, meaning sellers are in control. So what do? I'm interested in sell, but just because it breaks VWAP doesn't mean I have to go sell. You know, it doesn't work that way. As I said, those are playbooks I have. They come. I have to have a reason to go short, and then we go up. Mini FBO. So we fill those mini levels. Once again, you should know what a mini FBO is by now. We come into VWAP. You can already take in your short here, half size, just a quick half size. Add more here. And then stop loss, nice above the highs, catch that move. I didn't. I waited, went back down, reclaimed EMA. That yellow line is my EMA 13, which is sometimes also used as an entry model. Reclaimed EMA, held VWAP. So I was like, okay, I already want short. So I hit into it. It chops me up a bit, and then it fills down for 100 points. Massive trade. Why did I take it? Filled VWAP. Sellers are in control. Held my EMA. I took my 1 minute bar entry, massive short, as you can see. 1 minute bar entry, 100-point trade like that. Simple. Second example of a VWAP reclaim. You could see we're choppy. This blue line again is my EMA, my VWAP, sorry, and then my green line is my EMA 30. You could see that we're going above VWAP, so that's why I said you can't just long and short above VWAP or below VWAP. It doesn't work that way. You have to have an analysis, a strategy behind it. So I was already very bearish for the day, and I stayed away from trading all of that. And then at some point, I started seeing that NVIDIA was rolling over, multi-asset analysis, which I'll go into. And I was like, okay, I want shorts now. So my mind is like, okay, I want shorts now. What do I do? What is it doing? 1 minute bar break. Oh, we're breaking VWAP. We're breaking EMAs. Short. And I was able to catch a bit at these lows, and the rest break even. Unfortunately, I wasn't able to profit all the way everything because I was expecting a move harder down, but we never got it. But it showcased that, you know, that's why I took a short. I already showed you the executions. Then we're going to go into the third example. I think that's one of the best showcases. So where we're in a then once again, you have, as I said, you have either a break and reclaim or a retest. This is the retest example. So we have a break and reclaim and a retest where it doesn't break the the VWAP. So what do you see? I'm in with 3 contracts. I'm in with half size. So bear that in mind. We're very bearish. Market open 3:30. I'm in the EU, so that's 9:30 a.m. New York. Market is very bearish. So I'm already naturally wanting shorts. I'm not trying to long this. I'm trying to go short because I had a bearish bias. We go down, up, down, up. We approach VWAP. So I'm like, okay, I already want to be exposed to short. So in case it rolls over heavily, I already want to be exposed to short. So I took 3 contracts short. And I was going to add more if it came to VWAP to be in with 6 contracts. And one thing which you also should know that it's okay to also add half sizes. You also see me sometimes call out when I'm in Discord and or on stream when I'm taking trade and I say half size or full size. Whenever we get into a key level, whether it be a filled FBO, filled FBD, FBO, FBD, whether it be a bar, whatever, you could sometimes see me take half size trades, and that's because the EV is a bit lower, you know. Look, that short that I took, that's a front side short. Remember when I talked about backside and front side? This is a front side short. I just shorted into strength, which I never do. If I want the backside short, this is where I should have short. But I knew that we're very bearish for the day. We were going into VWAP, so I'm already exposing myself to shorts and taking half size entry, and I would have added more if it came to VWAP. And you could see we just rolled over immediately, never gave me a chance to add full size, which is okay. But you could see that that whole VWAP got retested. We're coming back to the volume weighted average price, and the short sellers attack it again. And we get that rollover where the VWAP holds it. And you could see we break the EMA as well, and we go down. And yeah, so what does the EMA do for me in those cases? I also have an indicator EMA example, but what does EMA in general do for me? EMA acts as a dynamic support and resistance. So when we're trending and we're holding EMA, I know that the price is going to continue moving along with the EMA. It's going to serve the EMA is what they call it. When we break off EMA, that sort of confirms a reversal. And then when we have a VWAP fill plus an EMA fill, that's dangerous. That's 100% reversal confirmation. Some examples of EMAs. You could see that I'm shorting small size as it's going down. And I was very bearish for that day. And that was the day where the NQ was breaking yesterday's low. And that's for episode 3.4. I remember where I go over it, but that's a specific why I was short on that day. But I took small size short, and you could see that I have my limit ready. I have my limit ready to take more as it comes back into the EMA. Never got back into the EMA. So in those 2 cases, if it came back to EMA, I would have added more size. Perfect. I would be risking these highs here, which is fine. And if it broke EMA, remember the EMA is dynamic, so it moves with price. If it broke EMA, I would have been out because I would have known that this is reversing. And you could see it just held EMA. And as I said, I don't use EMA much, but I have also on my chart that gives me an indication of where price wants to ride the EMA. And if it reclaims EMA, just like these cases here, so we're bearish for the day, you could see where this is sort of where it confirmed that buyers were in control. And then we rolled over, broke EMA again, and then we're rolling over, and then we're riding the EMA. As you can see here, we're riding the EMA, and then we break it again. We're rolling over at the open, holding the EMA, and then we go down. So the EMA is more of like VWAP for me, where I know that within a very small time, I don't really base my whole buys on it, but within a small time frame, just like this, where I'm quickly trying to take a trade, trying to take a scalp. Like let's say if I was short here on this 1 minute bar break here, if I took that trade, I would have known that okay, I want to risk above EMA. Because if it goes back above EMA, I know that I have no business shorting there. And just like it's a nice reversal indicator, it's also a nice trend indicator. So if it's holding the EMA, as you could see here, 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 then it gives you confirmation that this thing just still wants to go. So that's how I use EMA. And if I talk about EMA 13, if I talk about EMA, then you know that I mean the EMA 13, and then you know how I use it. VWAP reclaims and retests. We went into it a bit earlier, but this is just an example of when the VWAP reclaims. It means that it does this. Once again, perfect example here. It breaks out, it moves up, holds VWAP, reclaims the VWAP, and continues for the leg up. And what does that mean? That's a VWAP reclaim. So when I say VWAP reclaim, that's what I mean with a VWAP reclaim. And when I say a VWAP retest, in a bullish case, a VWAP retest is when it goes up, down, holds VWAP. As you can see, buyers are already stepping up, and then we move back up again. And in a short case scenario, it would have been vice versa. So it would have been the opposite, where we're going down, go back into VWAP, just like the other example that I already showed you guys. Let me bring it back up again. Like this one. Here, where in a bearish scenario, we move back to VWAP, we retest VWAP, and then we go back down again. So, two scenarios. VWAP retest, where we're in a massive trend up or down, and then we break it and we pull back into the VWAP and we go back up, or we have a reclaim of VWAP, where it exactly like this, where we hold VWAP because the other side is taking control. Like in this case, we were in a short or sellers dominated market. We went back up, reclaimed VWAP, and now buyers are in control. And as I said, mixed with the EMA, very, very important. If it breaks VWAP and also breaks the EMA and holds the EMA, then the reversal is 100% confirmed. So yeah, then you got yesterday's VWAP plus yesterday's close. And yesterday close, that means the price of closing yesterday. And that acts as a static support and resistance level. It acts as a key reference level for today's trading, and it's useful for bias analysis. So when price opens and we're above yesterday's VWAP, and I'll show you what I mean with yesterday's VWAP. And yesterday's VWAP, let me see. This is yesterday's VWAP. You see this? This is yesterday's VWAP. Same with this. So every time you see this, this is yesterday's VWAP. It's where the last price of VWAP was for the previous session. So whenever price for the current session opens below it, usually gives me an indication that we're bearish, because we're below the average weighted price of yesterday. And we're above it. When we open above it, we're bullish. Sometimes it could be that we open above it and it acts as a magnet and it comes down, retests it as a dynamic key level, and then we go back up. And that's what I call a yesterday VWAP. So whenever I go long or short on a yesterday VWAP, then you know what I mean with yesterday's VWAP. And I've backtested it, and it's a strategy that works perfectly for me and has been working in the equities market as well. And 8-figure traders that I know have been swearing by it as well. So I know that a lot of people within the future industry don't use it, but trust me, try it and you'll see. And that's the same exact thing for yesterday's close. Yesterday's close is the closing price, where if we're above it, we're green for the day, and we're below, we're red for the day. And usually I've also seen that it also acts as a nice, it's technically where the gap fills. So when we get to yesterday's close, we've technically filled the gap for the day. And it also acts as a very dynamic support, static support and resistance level, where if we get there and we retest back into it, and I'll show you an example, it's a nice short. And when we get we pull back into it and we're above yesterday's close, we pull back into it, it's a very nice dynamic long. Let me show you an example of what I mean with the yesterday VWAP, a trade that I took based on the yesterday VWAP. You could see half size. I've even written it, half size. Whenever we have a massive dump, let's say, into yesterday's VWAP, so this trade, you can't see it, but I took this because it dumped to yesterday's VWAP, and I took 3 contracts long, which I was going to add more if it didn't FBD. So if it went down, reclaimed, didn't FBD, I would have added my full size, but it never did. So I'm not just going to, because essentially what I did, I front ran this. So I took a trade on the front side. I just longed because I was like, okay, we're going to approach yesterday's VWAP. We're holding it. I see bits coming up. I long, but I'm not going full size because I never go full size on front side trades. On the back, I only go back side, as the other example that I showed you. I took a trade here, half size, on the front side long on the yesterday VWAP bounce, because I know, based on my strategy, that 60% of the time we will see bounces of yesterday's VWAP. And what do you see here? Perfectly played out. What do I have? A drawdown of what? 10 points. And I'm up 35 points, 40 points, 4-hour trade, 3-hour trade, just like that. And you can see that yesterday's VWAP is very nice to take also as an indication of bias. It's also nice to say, okay, if you're in short and we approach yesterday's VWAP, it's a nice exit strategy. If it reaches yesterday's VWAP, I'm going to get it out. But it's also a very nice idea of, let's say, taking a trade for half size. And then if you get more confirmation, you add your full size. And then we got yesterday's close. And I got 2 examples for yesterday's close. Let's see. This orange line, which is always on my charts on an orange line, this orange line is yesterday's close. And you could see that we technically hold it as a static support and resistance level. So you could see we get into yesterday's close, we go up, nice scalp, and then we fill yesterday's close and we're playing around it. And then once we fill it, we really fill it hard. And then mixed with the VWAP and the EMAs, you know, it's things I use on a day-to-day basis. And if I talk about it in the coming episodes, know that when I mention yesterday's close, that's a yesterday's closing price, and it's a static support and resistance. And you can see here as well, perfect example here, yesterday's close. That was yesterday's session that we live streamed. We have yesterday's close here, and you could see we come to it twice and we fail it both times. And you could see this is yesterday's VWAP. Coincidentally, I didn't even know that, but you could see it's not always that it holds, but you could see yesterday's VWAP. We get into these levels and we dump back down. So yesterday's VWAP and yesterday's close, whenever I talk about them, this is yesterday's VWAP, the last price where VWAP was for yesterday's session, and this is yesterday's close, which is the last closing price of yesterday's session. Regular trading hours, so not extended hours, regular trading hours, where the last price close was for regular trading hours at 4 p.m. New York session. And they act as dynamic static support and resistance. As you can see, it holds it. It holds it. Good thing to know. Opening range breakout. Dynamic intraday key levels sometimes gives indication of status of the choppy first range. High, low, low, high. Refer back to YouTube strategy. I'll put this because I already have a very nice YouTube video about opening range breakout. And that opening range breakout is something I also use as an indication of the status of the day. Are we going to be choppy, or are we going to see a nice ranging day? And usually when we're chopping around the opening range breakout, where I usually use the first 10-minute or the 50-minute chart. So when I talk about the opening range breakout, then I either talk about the 10-minute candle or the 50-minute. So if it holds the high of the 10-minute candle and it holds it very nice, then I'm expecting a nice ranging day. Vice versa for shorts. And if it chops around it, whether it's the 10-minute or 50-minute highs or lows, then I can expect a choppy day. Then I can expect that buyers nor sellers are in control. And sometimes I do use them. I use them as intraday key levels. So the high of the 10-minute candle, the low of the 15-minute candle, or 10-minute candle, they act as dynamic support and resistance, just like yesterday's close and yesterday's VWAP. So you could see me sometimes take a trade based on them. And you could see on my YouTube video where I went in depth about it, that how I use them. Let's put it that way. And then you've got high, low, low, high. I have a whole episode coming about high, low, low, high. And I'll explain what a high, low, low, high is. I have 2 examples here. A high, low, low, high is where the price is in a downtrend and it breaks the previous lower high. So we're in a downtrend like that. We break the lower high, and I don't know why I'm doing it with my hand. You can just open the chart. Those are 2 examples. This is the continuation. Yeah, this is the continuation. Those 2 trades are the same. This is just the continuation of it. But you could see we're in a downtrend. This is our lower high. Downtrend, downtrend, downtrend. Price breaks and makes a new high. around these levels here. So this point here and this point here. So our next high being made is what I call high, low, low, high. So whenever I'm on stream or whenever I'm trading and I say, okay, guys, this is making a high, low, low, high, I'm taking entry and I'm switching and I'm, I'm bullish for the day. That's because a high, low, low, high has happened. We're making new highs. Price structure is changing. Same as this. And that's why I went long. I was bullish for the day. We reclaim VWAP. We break EMAs. And you could see it all lines up together. High, low, low, high break. Whenever we say high, low, low, high break, that means that in a bearish scenario, we're going to turn bullish. And in a bullish scenario, which I hope I have a chart for in a second, we're going to turn bearish. So in this case, we're in a bearish scenario, as you could see, and we're breaking high, low, low, high here. So we're making a new high and here, and I'm immediately bullish and I try to find an entry. Just because I'm bullish doesn't mean I just click buy, buy, buy. No, I try to find an entry into that. And then what do you see? Pullback, momentum continuation. We do a mini pullback, momentum continuation, hold VWAP, break EMA, etc., etc., etc. And you can see we're holding, and was a very nice trade, $750 on this trade. And then the second example for the bearish case, you could see that we're up, down, up. This is our previous higher low. So this is our previous higher low. And if we continue, we're making higher highs and higher lows. That means we're in a bullish trend. But what happens? We're breaking this higher low. So what we're making newer lows. And that indicates a high, low, low, high break. So in a bullish scenario like that, we're in a bullish state and we do a high, low, low, high, we're turning bearish. The market is reversing. Price structure is changing. So now instead of being bullish and I'm only forcing longs, I'm like, okay, guys, we have a high, low, low, high. We just broke the previous higher low. So now what we're going to do, we're bearish. I'm trying to find bearish spots. And what do you see? Opening range breakout. This is the opening range. And you could see that I got a FBD, and once again, a failed FBD here as well. It reclaims that level and goes back down. It all always aligns with each other. But then in this case, high, low, low, high. So I'm bearish for the day, and I take my 1 minute bar, and I get a massive trade. As you could see, I could have even made more, unfortunately, but that's what I just was able to extract out of that trade. But you could see that when I'm talking about a high, low, low, high, when we're in a bearish state like this, that means that we're breaking previous higher low, and in a bearish state, like the example I showed you here, that means we're breaking the previous lower high. That means we're taking over with newer higher highs, and we're having a change of market structure where we're going to be bullish. And then we have multi-asset analysis. A multi-asset analysis is where you also see me do that a lot of stream, where I'm looking at SPY, I'm looking at NVIDIA, I'm looking at Tesla. Because remember, the NQ is an indice. It's being moved by other things. It's being moved by NVIDIA. It's being moved by equities. It's being moved by crypto. If crypto go up and you have ETFs that are within the NQ, let's say Bitcoin and IBIT. Bitcoin is a cryptocurrency. IBIT is an ETF that tracks it, and that IBIT is listed on the NQ, so you can trade it. And if Bitcoin goes up, IBIT goes up, IBIT will also pull up the NQ up. And I do that a lot. I look at the SPY, and if I see that the SPY is bullish or bearish, and the NQ is, let's say if SPY is very bearish and it's breaking yesterday's low, but the NQ didn't yet, then I know that I can expect that the QQ or the NQ will do it as well. Or if NVIDIA is breaking a major key level and it's breaking down and is very weak, then I can already expect that the QQ will follow, because NVIDIA is a market leader, just like Google. So what do? We leverage equity market strength. I leverage that. I look at things that are already moving. I look at the relative strength of equities, whatever ticker it be, whether it be Google, whether it be Tesla, whether it be SPY, whether it be NVIDIA, Meta, AMD. And I look at them, I'm like, okay, NVIDIA is breaking down. It's relatively weak to the market. So I know that if NVIDIA breaks down and NVIDIA creates that panic, then everything else follows along with it. And if everything else follows along with it within the chip sector or within the tech sector, then I know that NQ will follow it as well. We watch market leaders for early signals. Use equity momentum to confirm or invalidate future setups. I have a perfect example that I took the other day. And I took this on stream. You can even rewatch that on the 25th of November. You can see that NVIDIA, are we on the NVIDIA chart? Yeah, we're on the NVIDIA. We're on the NVIDIA chart, the 3-minute chart, and you can see that we break these levels on this is the 25th of November. We break this key level and we break this key level. What does it show you? We're showing that NVIDIA breaks yesterday's lows, what I call them, and I'll go over them in episode 3.4 on how I leverage yesterday's lows and yesterday's highs. But for now, worry about how I use multi-asset analysis. So you could see that I have my chart open. I'm watching NVIDIA. I have my NQ chart open and I'm watching NVIDIA. I'm like, okay, NVIDIA already broke yesterday's low. And you could see NVIDIA playing around below it at London session, and you could see market opens. We pop into VWAP, break pre-market low, and what do I see? I see NVIDIA is approaching to break this key level. NVIDIA is weak. There are a lot of short sellers attracted to NVIDIA, a lot of hedge funds, a lot of big players. They're shorting NVIDIA. What does that mean? If NVIDIA goes down, AMD goes down, the market follows it. NVIDIA is a market leader. A lot of eyes are on NVIDIA. And what do I do on the 25th of November? The market opens. I see NVIDIA being very weak. I see it being drawn to that yesterday's low level. It's being drawn and it's hinting like, look, Sheikh, I'm about to be broken. I'm about to be short sold. NVIDIA is about to go down. And then what do? I know that even though I might have a different bias for the NQ, I know that I want shorts. And then you could see massive short. You know, you could see once again here, yesterday's VWAP. What does it do? It breaks it. And if it breaks it, it acts as a dynamic support and resistance level. It breaks it, and you could see we go down on it. And you could see we retest back on it on these levels. We retest VWAP, we break VWAP, reclaim VWAP, hold yesterday's VWAP, go back down. Completely unrelated to this, but you could see that NVIDIA already at pre-market, without it being open already, showed me that it's weak, showed me that it's going to break these levels here. So I already knew before the day even started, I already knew that I wanted short. Yes, we went down, up, down, up, down. We chopped, because this is a 3-minute chart, mind you. On the 1 minute for for 10 minutes, we were chopping, and a lot of people probably lose money. But I knew that I wanted shorts, and I didn't take any shorts the moment it broke pre-market low. The moment it broke yesterday's view, I went short. And this is how I use multi-asset analysis. So whenever I'm looking at other tickers, other equities, or whenever I say, guys, look, NVIDIA is doing this, SPY is doing that, that's what I mean with multi-asset analysis. So yeah, I see this brings us to the end. Poof, hour 20. I even tried to make it a bit shorter and not talk too much and just go straight into it. But everything that I did, this is the playbook that I have. So every setup that I take, everything that I'll go over in episode 3.2, 3.3, 3.4, whatever, they come from this. So please, I beg you, know them. Because if you don't know them, then 3.3, 3.4, 3.5, whenever I go over them, you're going to be lost and you're not going to understand what I'm talking about. And if I keep on mentioning FBD, FBO, filled FBD, yesterday VWAP hit, this, that, you're going to get lost and you're not going to learn anything. So study these by heart, I'd say. You can always ask me questions in my Discord. The Discord link will be in bio. And I'll be able to give more clarification for the people that don't understand them or were a bit lost in this episode. But this is the fundamentals. This is the fundamentals of my trading. This is how I trade, and I've been doing very well, I believe. I hope so. Well, you could see I already have my December results and all green December, and I'm very proud of it. And those fundamentals, 82% win rate, 11.27 profit factor, zero days, 2.37 average win-loss ratio, my RR. So for every $1 I risked, I made $2.37, which is phenomenal. And yeah, this is the fundamentals of my trading. This is the foundation of my trading. Every trade I take is based on this, based on those setups, based on those playbooks that I just laid out. And I hope you guys like it. I genuinely hope you guys like this, and I genuinely hope you guys leave a comment. And if you have any questions, drop them in the comment. That's also okay. Please subscribe, and I'll catch you guys in the next episode.